In early 2022, a homeowner in Redmond, Washington, a software engineer, paid $550,000 over asking to get a four-bedroom house he wanted. The market was hot. Everyone said buying was the safest move of his life. 4 years later, the same house is on the market again. He is selling at a $200,000 loss. He is part of a wave of buyers who were told the same story everyone gets told. Rent is throwing money away. Buying is the smart move. Your home is the best investment you will ever make. The data tells a more complicated story. The average American homeowner has a net worth of around $430,000 compared to $10,000 for the average renter, a 43-to-1 wealth gap. It comes from the Federal Reserve's Survey of Consumer Finances, but that number hides as much as it reveals. The 43-to-1 wealth gap is real, but it compares two groups of people who differ in ways that have nothing to do with whether they own a home. Three things to understand. The first is age. The typical American homeowner is 57. The typical renter is 42. The older group has more wealth regardless of housing status. 15 extra years of saving, compound interest, career income, and inheritance. Age alone explains a significant chunk of the ratio. The second is selection. The people who can afford to buy in the U.S. are already wealthier than those who cannot. Higher incomes, higher credit scores, family money for the down payment. The act of buying did not create that wealth. It required it. The third is the part that actually matters. Buying a home is forced savings. When you write a mortgage check, a portion goes toward principal, which slowly turns into equity. Most people would never voluntarily save that money. They would spend it. The mortgage forces them to set it aside. The wealth gap is not proof that real estate is the best investment. It is proof that being forced to save outperforms not saving at all. A renter who set aside the same amount each month into a diversified index fund would have built wealth too. Almost nobody does. The mortgage solves for human behavior, not asset selection. Homeowners are richer because they are older, because they were richer to begin with, and because the mortgage forced them to save, not because the house itself is a financial miracle. Someone sees a mortgage payment of $1,200, compares it to their current rent of $1,300, and feels like they are saving $100 a month. They sign the paperwork. That comparison is wrong. Your rent is the most you will pay this month. Your mortgage is only the least. When you rent and the roof leaks, your landlord pays. When you own, you pay. When the water heater dies on a Tuesday morning, the renter calls the property manager. The owner writes a check for $1,500 before noon. The mortgage number on the loan document never changes. The number that actually leaves your bank account every month is volatile. Property tax bills get reassessed. Insurance premiums climb. The HOA raises fees. Something breaks. Rent rises too. Lease renewals can come back 10 or 20% higher. But rent rises on a schedule. The mortgage works in reverse. Predictable year to year, unpredictable month to month. You are comparing a ceiling to a floor. The mortgage is sold as the cost of buying a house. It is actually the cost of renting money from a bank for 30 years. As of June 2026, the average 30-year fixed rate in the U.S. is 6.52%. Borrow $300,000, and over 30 years you pay back $671,000. That is $371,000 in interest alone, more than the original loan itself. The mortgage is also front-loaded. In the first year, roughly 70 to 80% of every monthly payment goes to the bank as interest. Less than a quarter pays down what you owe. It takes most homeowners more than a decade before the math starts shifting toward building real equity instead of paying the bank. If you put less than 20% down, which many first-time buyers do, you owe PMI, Private mortgage insurance, on top of everything else. PMI runs 0.5 to 1.5% of the loan amount per year. On a $300,000 loan, that is $1,500 to $4,500 added to your payment until you reach 20% equity. It protects the bank, not you. The 43 to 1 number measures wealth at retirement age. It does not measure the $371,000 paid in interest along the way. Even if you paid off the mortgage tomorrow, the bills do not stop. 3 layers to walk through. The first is property tax. Local governments charge you every year for the privilege of owning land, and unlike a mortgage, this bill never gets paid off. The national average sits around 1.1% of home value per year, but in New Jersey, Illinois, and parts of Texas, it runs above 2%. On a $400,000 home in a 2% state, that is $8,000 a year, forever. The second is insurance. According to a 2026 Lending Tree analysis, average homeowner insurance rates rose 46.8% cumulatively between 2020 and 2025. The typical homeowner now pays around $3,300 a year. In Florida, the average annual premium is over $15,000. In California, major insurers like State Farm and Allstate have pulled back entirely, pushing more than 450,000 homeowners onto the state-backed FAIR plan. The so-called fixed mortgage is not fixed when one of its biggest line items climbs double digits year after year. The third is maintenance. Budget between 1 and 4% of your home's value every year for upkeep. On a $400,000 home, that is $4,000 to $16,000 a year. A roof replacement runs $15,000 to $30,000. An HVAC system runs $6,000 to $12,000. None of this money increases the value of your home. It simply prevents it from falling apart. Add the 3 together. On a $400,000 home, you are looking at $12,000 to $30,000 per year in hidden costs. $1,000 to $2,500 per month on top of the mortgage. To buy a $400,000 home, you need $80,000 upfront for a 20% down payment, plus another $10,000 to $15,000 in closing costs. Before you have moved in, you have handed over close to $100,000 in cash, and that $100,000 cannot be doing anything else for you. This is opportunity cost. Over the past 30 years, the S&P 500 has returned roughly 10% per year on average. The average American home has appreciated by roughly 4 to 5% per year, consistent with the Case-Shiller Home Price Index. Put $100,000 into a low-cost index fund in 2000, and by 2030, it would have grown to 1.7 to 2 million. Use the same $100,000 as a down payment on a typical American home in 2000, and you would have built roughly $400,000 to $500,000 of equity by 2030 before subtracting interest, property tax, insurance, and 30 years of maintenance. A house is a place to live with a savings account bolted to the side of it. The savings account exists. It is just less impressive than the math sounds. The math so far assumes everything goes right, but life is not stable. In 2010, NPR profiled Dawn Crowell, a single mother of 4 in St. Paul, Minnesota. Despite a weak credit record, she was approved for a home loan through a mortgage broker friend. The mortgage took up about 75% of her monthly income, far above the standard guidance of 28%. Then in 2010, she lost her job. The foreclosure letter started arriving. She tried to sell. She could not. The local market had dropped, and she owed more on the mortgage than the home was worth. That is called being underwater. You cannot sell. You cannot refinance. The only options are to keep paying a mortgage you cannot afford, or hand the keys to the bank and walk away with a destroyed credit score. Dawn was not an outlier. Millions went underwater in the 2008 crash, and it is happening to a different generation right now. In 2021 and 2022, during the pandemic housing frenzy, the typical American home buyer paid $65,000 over the original asking price, according to Anytime estimate. First-time buyers paid even more, a median of $77,500 over asking. Then mortgage rates climbed from under 3% to over 7%. Many of those buyers, like the Redmond engineer from the start of this video, are now selling at significant losses. Liquidity matters most when you least expect to need it. A house is a wonderful place to live until the moment you need cash out of it quickly. At that moment, it becomes the worst kind of asset. Illiquid, slow to sell, and priced by a market that does not care about your timeline. Buying and selling real estate is one of the most expensive transactions most people will ever participate in. Closing costs at purchase, loan origination, title insurance, inspection, appraisal, and transfer taxes run 2 to 5% of the purchase price. On a $400,000 home, that is $8,000 to $20,000 on top of your down payment paid in cash before you have moved a single piece of furniture inside. Then there is selling. An August 2024 lawsuit settlement against the National Association of Realtors changed how real estate commissions are negotiated. They are now technically negotiable instead of automatically baked into the seller's bill. In practice, the average total commission in 2026 is still around 5.7%. On a $400,000 sale, that is roughly $23,000 in agent fees. Add transfer taxes, title fees, and moving costs, and the total cost of selling lands between 7 and 10% of sale price. Buy a $400,000 home today and sell it for the same $400,000 5 years from now, and you walk away with substantially less than you came in with. That is why financial advisors generally say you need to plan on staying at least 7 to 10 years just to break even on entry and exit costs alone. There are two more costs that almost no one factors in. They do not show up on a mortgage statement, but they quietly cost homeowners enormous amounts over time. The first is being stuck. Your 20s and 30s are the highest earning decades of your working life. The fastest way to raise your income is to move toward better opportunities, a job in a higher paying city, a promotion that requires relocating. Renters can take these. Give 30 days of notice and you are gone. Homeowners cannot. A homeowner with a job offer in another city has to sell the house, become a landlord, or maintain 2 households at once. The selling process takes 3 to 6 months. The fees eat 7 to 10% of sale price. Research has consistently shown that home ownership reduces job mobility and that workers who move toward better opportunities earn substantially more over their careers. The house can quietly cap your lifetime earnings. The second is lifestyle creep. When you move from a small apartment into a larger house, your old furniture looks too small, so you buy a bigger sofa, a longer dining table, new bedroom sets, art for the empty walls. None of it holds its value. Then comes the yard, the landscaping, the snow removal. Then comes neighborhood pressure. Nicer cars in the driveways, cleaning services on every block. These costs do not show up in mortgage calculators, but they are real money diverted from investing, from emergency funds, from retirement accounts. And they keep adding up for decades. Everything so far has been a case for skepticism. Now the other side, buying can absolutely be the right decision. The mistake is treating it as a default rather than a calculation. 4 conditions that, when they line up, make it a strong move. The first is time horizon. Stay in the same location for at least 7 to 10 years, and the math starts to work. Long enough to recover entry and exit fees and build meaningful equity. The second is affordability, with a real margin. Your total monthly housing cost, PITI plus maintenance, should not exceed about 28% of gross monthly income. Lenders also look at debt-to-income ratio, or DTI. Most conventional loans want that below 43%. Above those thresholds, and you are sacrificing financial flexibility for ownership. The third is career stability. If your income is steady and your job is tied to a region you want to stay in long term, the immobility problem disappears. The fourth is personal disposition. Some people benefit from the forced savings of a mortgage because they would otherwise spend that money. Others will reliably put the same amount into index funds every month if they rent. Knowing which one you are matters more than the headlines. One more factor, the tax treatment of profits when you sell. The IRS lets homeowners exclude up to $250,000 of capital gains from the sale of a primary residence, or $500,000 for married couples filing jointly, as long as you have lived in the home at least 2 of the last 5 years. One of the most valuable tax benefits available to middle-income Americans. When those conditions line up, buying is one of the better financial moves available. When they do not, buying is a trap that compounds against you for decades. Stop thinking of a house as the only path to wealth. Think of it as a lifestyle choice with a financial component, and build your real wealth in diversified liquid investments alongside it. The 43-to-1 wealth gap is real, but it is not magic. Homeowners are richer because they are older, because they started with more, and because the mortgage forced them to save. Those are explanations, not endorsements. The math underneath tells a more complicated story. $371,000 in interest at current rates. PMI if you put less than 20% down. $12,000 to $30,000 a year in hidden costs that never appear in any listing. Closing fees on the way in, agent commissions on the way out, friction that requires 7 to 10 years just to break even, a down payment locked into the walls instead of compounding in the market. None of this means renting is the answer either. Renting has its own costs, its own lack of equity, its own annual increases. Housing is a major financial decision, not a default one. Run the actual numbers for your actual situation. Compare the real total cost of ownership against the real opportunity cost of investing the difference. Match the choice to your life, not to the story everyone keeps repeating. If this changed how you see the buying versus renting question, hit subscribe so the next video lands in your feed, like the video if it earned it. Tell me in the comments, are you team buy, team rent, or somewhere in between? See you in the next one.